Welcome to this YouTube channel. In this video we are going to talk about how to invest in stocks for beginners. So before starting the video, please like this video and subscribe this YouTube channel for future updates. When you buy stocks, you are betting on the company's long-term success and growth. Depositing funds into an online investment account, which can later be used to purchase shares of stock or stock mutual funds, is one of the greatest ways for novices to learn how to invest in stocks. You can open a brokerage account and begin investing for the cost of one share of stock. Some brokers also provide paper trading, which enables you to practice buying and selling stocks using stock market simulators before making a real money investment. How to buy stocks in 6 easy stages. There is no one size fits all approach to stock investing, but following this 6-step procedure could give you a head start. Decide how hands-on you want to be first. Open a bank account. Decide on your investing strategy. Establish a spending limit. Keep your eyes on the long term, and adjust your portfolio as necessary over time. Remember that a good rule of thumb is to create a diverse portfolio, and then maintain the investment, even during ups and downs markets. Number 6. Choose your stock market investment strategy. The process of buying stocks can be approached in various ways. Select the option that most closely reflects your investment goals and level of stock selection involvement from the list in next. B. You might be a good candidate for a robot advisor, a firm that offers low-cost investment management, saying, "I'd prefer an expert to oversee the process for me." These services, which invest your money for you depending on your individual goals, are provided by almost all of the big brokerage firms and a wide range of independent advisors. See, one of the most typical methods for beginners to start investing is with a statement like, "I'd want to start saving in my employer's 401k. It teaches new investors how to invest using some of the tried and true techniques, such as making tiny regular contributions, keeping an eye on the big picture, and maintaining a hands-off attitude. The majority of 401k plans provide access to a small number of stock mutual funds, but not to individual equities. Number 5. Choose a brokerage account. When you've made up your mind, it's time to look for an investment account. This typically entails opening a brokerage account for the practical kinds. An intelligent choice for people who need a little assistance is to register an account with a robo-advisor. Both procedures are explained below. A crucial point: you can start an account with very little money with both brokers and robo-advisors. Creating a brokerage account on your own. Your best option for buying stocks, ETFs, and a range of other investments is probably an online brokerage account. If you're already appropriately saving for retirement in a 401k or another plan through your company, you can open an individual retirement account, or IRA, with a broker. Alternatively, you can start a taxable brokerage account. The non-active choice is to open a robo-advisor account. A robo-advisor provides the advantages of stock investing without requiring its owner to put in the time and effort necessary to choose individual assets. Robo-advisory services offer whole investment management. Throughout the onboarding process, these businesses will inquire about your investment objectives before creating a portfolio for you that is intended to help you meet those objectives. Although the management costs may seem high, they are typically much lower than what a human investment manager would charge. The average robo-advisor takes 0.25% of your account balance. Yes, if you want, you can also get an IRA through a robo-advisor. You probably don't need to read any further in this article if you decide to register an account with a robo-advisor. The rest is only for do-it-yourselfers. Number 4. Get familiar with the distinction between investing in stocks and funds. Choosing a DIY approach? Not to worry. It's not necessary to be difficult to invest in stocks. Most stock market investors must select between these two sorts of investments: exchange-traded funds or stock mutual funds. With mutual funds, you can buy a variety of equities in small quantities all at once. A type of mutual fund called index funds and ETFs follows an index. For instance, an S&P Wink with tongue sticking out 500 fund mimics the index by purchasing the stock of the companies that make up the index. When you contribute to a fund, you also acquire a minor stake in each of those businesses. To create a diverse portfolio, combine different funds. Keep in mind that equity mutual funds are another name for stock mutual funds. Specific stocks you can purchase a single share or a small number of shares to test the waters of stock trading if you're interested in a certain firm. It is feasible to create a diversified portfolio consisting of numerous individual equities, but it requires a sizable investment and extensive research. If you choose this path, keep in mind that there will be ups and downs for particular stocks. If you choose to invest in a firm after doing your research, if you get nervous on a bad day, remember why you chose that company in the first place. Stock mutual funds have the advantage of being naturally diversified, which lowers your risk. The obvious choice for the great majority of investors is a portfolio composed primarily of mutual funds, especially for those who are investing their retirement resources. Number 3 for your stock market investment: create a budget. In this stage of the process, new investors frequently have two inquiries. How much cash do I need to begin stock investing? Depending on how pricey the shares are, you will need a certain amount of cash to purchase a single share of stock. Share prices can run the gamut from a few dollars to several thousand. Exchange traded funds (ETFs) can be your best option if you want mutual funds but have a limited budget. ETFs trade like stocks, so you buy them for a share price, in some circumstances, less than $100, but mutual funds frequently have minimums of $1,000 or more. What amount of money should I put into stocks? Have we stated that the majority of financial experts prefer you to invest through funds, especially if you have a lengthy time horizon? You can dedicate a sizable portion of your portfolio to stock funds. An investor aged May 30th invest 80% of their portfolio in stock funds and the remaining 20% in bond funds. Another situation involves certain stocks. Keep these to a minimum as a general rule of thumb for your investment portfolio. Number 2, put your attention on long-term investing. One of the most effective strategies to increase money over the long run is through stock market investments. Throughout several decades, the average annual return on the stock market has been around 10%. But keep in mind that's simply an average for the overall market. Some years will be up, some down, and the returns on specific stocks may vary. No matter what is happening on a day-to-day or annual basis, for long-term investors, the stock market is a smart investment because they are searching for that long-term average. If you begin investing in stocks or mutual funds, the smartest course of action may also be the most difficult. Don't look at them. It's a good idea to break the habit of continuously monitoring how your stocks are performing multiple times a day, every day, unless you're trying to defy the odds and win at day trading. Number 1, keep an eye on your stock holdings. There will be moments when you need to check up on your stocks or other investments, even though worrying over daily changes won't do much for the health of your portfolio or your own. If you use the following techniques to acquire mutual funds and individual stocks over time, you should periodically review your portfolio to make sure it still meets your investment objectives. Some things to think about. If you're close to retiring, you might want to convert some of your stock assets to more conservative, fixed income investments. Consider purchasing stocks or funds in a different sector to increase your portfolio's diversification, if it is overly concentrated on one industry or area. Finally, consider geographic diversification as well. Vanguard advises having up to 40% of your portfolio's stocks be foreign stocks. To have this exposure, you can buy global stock mutual funds. What do you think about this video? Do let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.